The numbers don't lie, and right now, they're screaming. NVIDIA's market cap just crossed $3.5 trillion. Microsoft's AI division is valued higher than the entire German economy, and venture capital firms have poured $250 billion into AI startups in the last 18 months alone. Here's what nobody is telling you. I've been tracking 7 specific indicators that have appeared exactly 3 times in modern financial history: 1999, 2007, and right now. And each time, what came next wiped out trillions in a matter of weeks. Let me show you something that should make your blood run cold. Pull up a chart of the NASDAQ from 1998 to 2000. See that exponential curve? That vertical climb in the final 18 months? Companies adding .com to their name and watching their stock price triple overnight? Now look at AI stocks since ChatGPT's launch in November 2022. The same curve, the same parabolic trajectory, the same irrational exuberance. In 1999, if you were a skeptic warning about .com valuations, you were called a dinosaur who didn't get it. The internet was going to change everything, they said. Companies didn't need profits. They needed eyeballs and market share. Sound familiar? Today, if you question whether a language model justifies a $2 trillion valuation increase, you're told you don't understand exponential technology. AI is different, they say. This time, it's not a bubble. It's a revolution. But here's the thing about bubbles. They're always built on something real. The internet was revolutionary. E-commerce did change everything. Amazon, Google, Apple, they survived and thrived. But 90% of .com companies went to zero. The question isn't whether AI is transformative. It obviously is. The question is, are current valuations based on realistic revenue projections, or are they based on fantasy? And when I looked at the actual numbers, the revenue per employee ratios, the customer acquisition costs, the timeline to profitability, I found something that kept me up at night. Here's the core issue that Wall Street doesn't want you to focus on. The math doesn't work. Let me break this down. The 7 largest tech companies have added roughly $10 trillion in market cap since the start of 2023, almost entirely on AI hype. To justify these valuations using traditional metrics, even generous ones, these companies would need to generate an additional $500 billion in annual revenue from AI within the next 3 years. The entire global cloud computing market took 15 years to reach $500 billion. The smartphone revolution took a decade. And those technologies had clear, immediate use cases that people were willing to pay for on day one. Now, I'm not saying AI won't generate massive revenue, but here's what I'm tracking. Revenue per AI dollar invested is declining, not increasing. Companies are spending $3 to $5 for every $1 of AI-generated revenue. That's not a business model. That's subsidized hype. Customer churn rates for AI services are accelerating. Companies sign up for enterprise AI solutions, realize they can't integrate them effectively, and quietly cancel within 6 months. The renewal rates that analysts are projecting, they're fiction. The energy problem nobody's pricing in. Training GPT-4 cost an estimated $100 million in compute alone. Training the next generation of models could cost billions. But here's the kicker. Energy costs are rising, not falling. Data centers are hitting power grid capacity limits in Virginia, Ohio, and Arizona. Physics doesn't care about your growth projections. There are roughly 300,000 qualified AI engineers globally. Tech companies are bidding salaries up to $500,000 to $900,000 for senior talent. Those costs get capitalized into stock valuations, but the revenue to support those salaries, it's not materializing at the same pace. But here's the signal that concerns me most. In the last 4 months, insider selling at major AI companies has reached levels we haven't seen since early 2000 and mid-2007. CEOs and board members aren't selling 10% or 20% of their holdings. They're selling 40%, 50%, sometimes 60%. They're on CNBC talking about AI changing the world, while filing SEC forms to dump their shares. Now, to be fair, insiders sell for many reasons. Diversification, tax planning, buying a yacht, whatever. But when you see coordinated selling across multiple companies in the same sector at the same time, while public sentiment is still euphoric, that's not diversification. That's an exit strategy. So how does this actually crash? What's the trigger mechanism? Let me walk you through the most likely scenario based on how bubbles have historically popped. One of the big 7 AI companies reports quarterly earnings that disappoint. Not a disaster, just 2% or 3% below analyst expectations. Maybe their AI division grew 40% instead of 50%. Still impressive, right? Wrong. When a stock is priced for perfection, when it's trading at 60 or 70 times earnings based on the assumption that growth will accelerate forever, even a small miss triggers algorithmic selling. High-frequency trading systems don't care about the AI story. They care about momentum, and momentum just cracked. The stock drops 8% after hours. Analysts start downgrading price targets, not because they think AI is dead, but because they're forced to acknowledge that their growth models were too aggressive. A few hedge funds that were over-leveraged in AI stocks get margin calls. They're forced to sell positions to cover. Now it's not one stock down 8%, it's the entire sector down 12%. This is where it gets interesting. Bloomberg runs a front-page story. Has the AI boom gone too far? The Wall Street Journal publishes an investigation into AI revenue projections, showing that most companies overstated adoption rates. A major AI startup quietly shuts down after burning through $800 million in funding. The narrative flips from AI is the future to AI might be overhyped. Retail investors who bought at the top start panic selling. Reddit forums that were bullish turn bearish overnight. YouTube videos with titles like "I lost everything on AI stocks" start going viral. Here's where it cascades beyond tech stocks. Banks that lent billions to AI startups against equity collateral suddenly realize that collateral is worth 40% less than it was 6 weeks ago. They tighten lending standards. Venture capital firms that raised huge AI-focused funds can't deploy capital because valuations are collapsing. AI startups that were valued at $2 billion 6 months ago can't raise their next round at $500 million. They start laying off staff. Those laid-off engineers flood the job market, putting downward pressure on tech salaries. Tech workers who felt rich on paper because of their stock options suddenly feel poor. They cancel home purchases. They cut discretionary spending. Consumer confidence in Seattle, San Francisco, and Austin drops off a cliff. And because tech spending has been supporting everything from commercial real estate to luxury goods to restaurant industries in these cities, the pain spreads. This is how a $10 trillion bubble bursting becomes a $20 trillion economic problem. Now let me show you why I'm so confident about this pattern. In 1999, Cisco Systems was the most valuable company in the world. Its market cap peaked at $569 billion, roughly $1 trillion in today's dollars. Cisco made the routers and switches that powered the internet. Their technology was essential, their growth was real, and then their stock dropped 89% over the next 2 years. Not because the internet failed, not because their technology was bad, but because the valuation assumed a level of growth that was mathematically impossible to sustain. Cisco's revenue in 2000 was about $19 billion. To justify their market cap, they would have needed to grow to $100 billion in revenue within 5 years. They never got there. 25 years later, Cisco's revenue is around $57 billion, and their market cap is still below their 2000 peak. Let that sink in. 25 years later, the same thing happened with housing in 2007. Yes, people need houses. Yes, real estate has value. But when prices assume that appreciation will continue at 15% annually forever, you have a bubble. And when that bubble pops, even good assets get crushed. AI will be transformative. It will create trillions in value over the next 2 decades. But that doesn't mean current prices are justified right now. 3 weeks ago, a regional bank in Ohio launched an AI growth fund for retail customers. Your grandmother can now invest her savings in a basket of AI stocks with a 2.5% management fee. When taxi drivers were giving stock tips in 1929, the crash came 4 months later. When your hairdresser was flipping condos in 2006, the crash came 18 months later. When Fidelity launches an AI ETF for retail investors who don't know the difference between a large language model and machine learning, we're in the final stage. I'm not saying sell everything tomorrow. I'm not saying AI is a scam. What I'm saying is this: the risk-reward ratio has completely flipped. If you own AI stocks at these valuations, you're risking 60% to 80% downside to capture maybe 20% more upside. That's not investing. That's speculation with asymmetric risk against you. So what does this mean for you? If you're heavily invested in tech stocks, especially AI-focused companies, you need to ask yourself, am I comfortable losing half of this position? If the answer is no, it's time to rebalance. If you work in tech, especially at an AI startup, understand that the easy funding environment is over. Companies that can't demonstrate a path to profitability in the next 12 months are going to struggle. Update your resume, build your network. Don't assume your equity is worth what your last funding round suggested. If you're in a related industry, commercial real estate in tech hubs, luxury goods, high-end services, understand that a tech correction will flow through to you. Plan for a tougher 2026 than you're currently forecasting. But here's the other side of this. Every bubble creates incredible opportunities on the way down. Amazon dropped 95% from 2000 to 2002. If you bought at the bottom, you made 1000x your money. The question is, do you have the capital and the courage to buy when everyone else is panicking? Look, I could be wrong about the timing. Maybe this runs for another 6 months. Maybe it runs for another year. But I'm not wrong about the pattern. The math doesn't work. The insiders are selling. The retail enthusiasm is peaking. And history suggests that when all three of those conditions align, what comes next isn't pretty. So here's my question for you. Are you positioned for what happens if I'm right? Or are you assuming that this time is different? Because I've studied every major bubble in modern history, and I can tell you with certainty, it's never different. Drop your thoughts in the comments. Are you rotating out of AI stocks, or are you holding through whatever comes next? And if you found this valuable, you know what to do.